Welcome everyone now. So what we'll do now is we'll get started on the webinar. There are a couple more people who are likely to join us, but as they join us, we'll just take it from there. So my name is Tech 10 from i3, and well, welcome to this first virtual event that we are doing. Thanks to Jonathan for offering to share some of his perspectives during this very difficult time. Before I pass the time to Jonathan, let me just explain how this is going to work, and then we can take it from there. So once I've done the introductions, I'll pass the time to Jonathan. He will speak for about 5 to 10 minutes, probably not more than 10 minutes. We've got a handful of slides going through what's happening now. And I think more importantly, Jonathan, as we've spoken, what I'm interested is with what's happening, and there's lots and lots of commentaries out there. So the focus is not so much on what's happening, but what it means for the portfolio. So 5 to 10 minutes, Jonathan, with your slides. And then for the next 20 or so minutes, it will really be a Q&A between myself and you. Hopefully I've got enough hard questions for you. Currently in the audience, the rest of you, please bear with us. You are all muted. I guess depending on which device you're calling in, you can either see or hear. Once we go into Q&A, we will unmute you, and I guess we'll figure a way out for you to ask questions. There is also a chat box on the control panel, so you can type in questions, or you can just raise your hand and ask questions. So we'll see how we work there once we get into the Q&A part. So again, just to reiterate, the format is 5 to 10 minutes presentation by Jonathan, and then the next 20 or so minutes Q&A. So we'll try to run this session in the next sort of 30, probably 40 minutes, depending on the questions and interaction. So without further ado, I might just pass the time to Jonathan, and we'll put Jonathan's slides up there so they can follow from there, and I'll just mute myself from here.
Right. Well, welcome everyone, and thank you for giving up your precious time to join us. And thanks also for Tech and Sophie and i3 for making it possible. It is a bit of an experiment, and I'm not going to talk about COVID-19 for very long because most of you are probably bored stiff with it all, except to say that in healthy people who live in countries that are isolated, like Tonga and Samoa and Nauru and Tuvalu, and to a lesser extent New Zealand, and those that have good health systems, there's a very low risk of dying if you get COVID-19, less than 1 in 1,000. So the death rates aren't as high as the fear of dying which the media presents. So basically moving on to the markets, in the middle of February, stock markets were at record highs, interest rates were then near record lows, and everything seemed pretty rosy, except that in hindsight, the valuations were unsustainably high, fueled by the massive debt levels around the world, which were about 20% higher than they had been during the global financial crisis. And suddenly, almost to a person, on the 20th of February, people realized that what they thought was a localized problem in Wuhan, in the Hubei province of China, was actually a global event, an epidemic at that point, which became a pandemic. And fear gripped the markets, and stock markets fell very rapidly. It was actually the fastest fall that the Dow has ever had in its over 100-year history. And the markets dropped about 30%. That was partly compounded by the fact that Saudi Arabia and Russia decided to have a tiff over oil. And both countries are producing more, especially the Saudis, and that more than halved the price of oil. So this further spooked markets because US shale oil producers borrow to develop their fracking using high yield bonds. So bond markets were under pressure. Liquidity dried up in all markets, despite central banks starting to put more money into the interbank lending rate and buying bonds and mortgage-backed securities. But it happened so fast that whilst they moved extremely quickly and all together, so they've done a really good job as best they could, bond yield spreads blew out and high yield spreads went up by over 20%, by plus 20% per annum. So that's how fast they blew out. And that affected corporate grade credit, including bank debt. Then governments started to realize that one way of tackling the crisis was to restrict access to their citizens from each other and slow the rate of transmission. And that was basically to try and flatten the curve and give their health services time to recover and prepare and get the right equipment and that sort of thing. But governments also provided emergency funding and fiscal support. But of course, the restrictions on access, and in New Zealand, we're locked down. We can only spend time in our bubbles with our immediate people we live with, unless we're in essential industries, and everybody's working from home. So that's triggered a recession globally. Fortunately, though, markets started to recover. So although the S&P 500 had dropped by over 30%, it only finished the month down by 12.5%. So there was extensive buying towards the end of the quarter as managers rebalanced their portfolios and the short sellers had to reposition as well. So in that sense, there was a bounce. That bounce is continuing. But let's look at the economies first of all. All economies have slowed. And fortunately, China, which got struck by this first at the beginning of the year, is now gradually reopening parts of their economy. And pockets are reopening, but of course, when parts reopen, then the risk of contagion goes up again. And so it's a little bit tricky, but so far so good there. And in New Zealand, we hope to reduce the level of constraint from the lockdown at the end of the month. In countries like Austria and Sweden, who haven't actually had a lockdown, are looking to relax in terms of shops and social contact. But some other countries who are really hard hit may take until next year to get over this. So we're expecting a stop-start sort of scenario. Each country is unique because their demographics are different, and this particular disease hits the elderly and infirm very hard. It's less of a problem for very young children, and healthy adults shouldn't have a problem either, unless they're really unlucky or have some underlying congenital condition that they didn't know about. So the long-term scenario depends on whether COVID-19 is contained or eradicated, or whether vaccines can be made to work and brought up quickly enough. We don't think you need to have the vaccines to enable some restrictions to be lessened and some level of economic activity to start again, but that's up to individual governments advised by their health authorities. So we'll see. So we're expecting a relatively short-term recession in fortunate countries that are managing through the crisis pretty well, but we're expecting an L-shaped recovery for markets because different countries have been hit much harder than others, and we're not going to get that same upswing in the global economy that we enjoyed a few years back. And I think the fundamental thing is that life has changed forever. This isn't a short-term thing where we can just go back to, wind the clock back to January and say, isn't life great again? There will be a lower level of productivity and a lower level of wealth, and life will be more of a struggle for a lot of people going forward. So the outlook for markets. Fortunately, those credit spreads that blew out are coming down again, and we've got positive yield curves at unheard of low interest rates. So we used to have the situation where the New Zealand cash rate was low at 75 basis points. It's now down to 25 basis points. And effectively, as I say, you've got a very flat yield curve, so low interest rates for quite a while. And then some businesses will be terminally impacted on this, but others should come back over time. I'm waiting to go and see my doctor so I can check with him on when it would be safe to travel by air again. But I'm not expecting to be able to visit any of our Pacific Island clients on site this year. We expect markets to remain volatile, but active stock and bond pickers are now able to find pockets of value in these different businesses and different levels of credit worthiness of those corporate bonds and governments. So we're seeing some positive involvement in the markets, which should keep going. There is a small risk that the stock markets fall further. In other words, another bounce downwards, like a W. But we think, for some reason, it's just changed today. There seems to be more optimism around the world, partly because I think the exposure to COVID-19, the number of cases is flattening off, and the number of deaths is actually, and the probability of death is actually going down slightly. Cash is still king, but we believe now would be the time, if you had a big cash reserve, to start cautiously reinvesting back into the markets with a view to taking advantage of these relatively good stock prices at the moment. There is a risk that another bubble forms because with all this quantitative easing and monetary and fiscal pumping in of cash, basically governments and central banks have emptied all their ammunition. So if there is something else that happens, and we suspect something may happen in the last quarter of next year, then the governments and central banks will have no dry powder with which to fight it. So I hope that wasn't too long and that I didn't go too fast, but I'll now hand back to Tech so that he can start the next part of the session.
Thank you very much, Jonathan. Can you hear me, Jonathan?
Yes.
Okay, good. Thanks very much for that overview. What I maybe would try to do now the next 10 minutes before we open up to questions perhaps from the audience is, as I mentioned earlier, to sort of take the overview that you have done and think of how that translates to the portfolio. You've covered quite a few things at that very broad macro level. You mentioned about the risk of recession, volatility, obviously, and credit stress blowing out initially and then coming down. So if I take you to at the very high level at a portfolio, when we think asset allocation, and I guess 101 allocation, asset allocation, you think about equities versus bonds versus potentially some cash. How do these different from broad categories of assets interact and correlate in the current scenario? Before the crisis and currently, how should investors be thinking about that sort of asset allocation level at that very high level?
So initially there was some correlation between equities and bonds. In other words, as people sold equities, they bought bonds, and interest rates on those bonds, because more people were buying them, the yield went down. So there was good correlation. But then in that very rapid sell-off, investors who needed cash sold everything that moved, everything that was liquid. We even ran out of Aussie government bonds. The RBA had to put some money back in because that market became illiquid. So everything that could be sold was, and there was no correlation between equities and bonds. That everything was correlated. They went the same way. And the difficulty was that obviously high yield bonds, they were horrible. But even government bonds in some markets was tight. And effectively, the only place that you had to protect capital was cash. And some managers had a good cash buffer. Others had run theirs down because they thought that they could use corporate bonds and get a slightly higher yield. Now, in that, when the expansion of those credit spreads blew out, effectively those mark-to-markets at the end of March caught them. But as long as they held those bonds, they're now generating higher returns, and so you're going to get a bounce back. So in that sense, going forward, we're expecting very little running yield from bonds and a better running yield from some shares. The interesting thing will be to see how many businesses keep paying dividends on those shares and how many are forced to stop because they're not making big enough profits to be able to afford to pay dividends. So in that sense, we still think that in terms of income, you're better off having a reasonable proportion of shares, some of which will generate capital gains and some others that will pay dividends. But then having some bonds is clearly good if you can get some reasonable yields on those bonds. But cash is still king, and that's why we feel that you've got to be careful, but you can start deploying some of that cash.
I wanted to come back to the question on bonds a bit more. We'll drill down a bit more as to perhaps talking about govies or government bonds and credits and different sort of credits. But perhaps I can just go back again to the earlier question at the high level. I know that a couple of Pacific Island funds are invested in multi-asset funds to get that broad exposure. Could you give us a sense of your interaction with the multi-asset funds there, and given the fact that they do asset allocation across the board, how have they been performing, and what have they done since then?
Yes, so there's one question behind that question you've asked, Tech, which I must just say at the outset, and that is, with the disruption to society caused by the lockdown in some countries and the pressure on people to protect their families and get their businesses and everything else going again, there's been a lot of distractions. And one of the beauties of using these multi-asset funds is that you delegate the asset allocation decisions to the managers. And so they've been able to get on and take those asset allocation decisions independently of the governance structure and the board of directors. So you didn't have to have an investment committee meeting and saying, change the asset allocation. The managers did that themselves, and they did it very well. In the main, a lot of the multi-asset managers sold down their equities towards the end of January, and in some cases early in February, and reduced the risk. But some of them got caught, as I say, by not getting good enough quality bonds and by not having enough cash. So the range of returns was very, very different. The best one we've got for the month of March got a -1%, but some got a -12, depending on, and some of those were caught out, as I say, by the poorer credit quality. Others were relying on derivatives and hedge fund type instruments for their alternatives. And a lot of those didn't work, as they didn't in the last quarter of 2018, simply because the whole market got sold off so harshly that it didn't actually, the job wasn't done the way that people thought it would be. So in that sense, obviously these managed funds didn't go down in many cases as far as the markets did, but on the other hand, they didn't protect investors by as much as the investors would have expected or hoped, simply because of that lack of correlation or the fact that they were 100% correlated, equities and bonds, during that second part of the sell-off after people started selling bonds as well as equities, just in the search for cash to realize assets.
So leading on to, I guess, the question around bonds and credit, and I guess there's a bigger question there, as in, we need equities for growth and returns, so that goes without saying. Then the question becomes, what is a diversifier? Bonds or credit have been seen as a diversifier. Have bonds or government bonds, if I could just be a little more specific, government bonds and different sort of credits, what's your take on that as them being a diversifier during this time?
Well, now going forward, yes, they will be diversified because, as I say, the governments have pumped in so much extra liquidity fiscally, and the central banks are making sure that the markets do function. The problem you have with bonds is that the yields are very, very low. You're getting a 1.3% or 1.2% yield on 30-year US Treasuries. So you're not getting much better than cash, and you're locking yourself in because one of the other things that happened during that sell-off is that the buy-sell spreads blew out as well. So the cost of trading in the bonds was much more expensive than normal. Normally you can trade a government bond in a decent chunk at a 1 or 2 bip price, but that got out to 5 bips and even more. So trading costs have gone up, and in that sense we still prefer cash, shares, and some private equity in some markets. Again, we like the Australasian markets because our countries are relatively isolated, so the risks from COVID-19 are less, but also our economies are reasonably well governed and regulated, and the reserve banks are doing their jobs. And we've got the SG and KiwiSaver propping up the markets. So in that sense, private equity in Australasia is good. Some infrastructure projects should be good, but there again, it depends on whether the restrictions on people's movements slow the progress of building. I mean, there's no point in having a big infrastructure project if you can't get people to go and work on it, because they've got to be socially distancing themselves.
Sure. I might put the illiquid stuff on infrastructure and property one side first. We might come back to that later. Can I go back to the main asset classes at a high level, where equities, in your commentary, you talk about recession. Obviously, we are in it, or we are about to go in it, and so on and so forth at a high level. What does recession mean for our portfolios, for investors' portfolios?
Well, funnily enough, some businesses actually make more money in recessions than others. Banks, finance companies, for example. So in that sense, again, you can't just assume that because a country's in recession that their stock market is going to go down in value. Normally, the recession happens after the stock markets have gone down, and from there, the markets can go down again, as they did during the Great Depression of 1929 and 1930. They got to their bottom in 1932. So that's possible here. But we
Sure.
think this is going to be a very short-lived recession in some countries. And so we don't think the impact on markets and businesses' earnings are going to be as severe as some people think. And that's what the market thinks as well, because they're refinancing Sydney Airport, Auckland Airport, and Flight Centre, for example, none of whom can operate very much at the moment, but they're able to attract shareholders' funds to prop up their balance sheets in the meantime.
Okay. And again, if I could draw that in to 2 points here. One is there's been, if you like, I call it the Sesame Street, or call it the alphabet soup of recession alphabets. There's the U and the L and the W and the and so on. So that's one part. But without going too much into it, again, what does recession and the various modes of recovery mean for the construction of your portfolio? So how you put your various assets together? Do you go more equities, more bonds, more illiquids? How, again, I'm trying to link, you know, that macro picture into how that translates into your portfolio construction or portfolio construction for the investors that are listening in.
Yeah. So what we do is we look at the value that each individual asset class offers. So at the moment, cash offers a zero return, but a zero risk of negative return. Bonds offer a 1 or 2% return, but a big risk of a negative return in the short term if interest rates do go up a little bit. And then shares, they offer a 2 or 3% return, depending on what sort of share they are and what sort of growth there is, because I'm talking about dividends here, not capital growth, but with a risk of another 10% downside. So it depends on the client's objectives, their need for income and their need for capital growth, and how risk averse they are. And so there's no clear, simple decision that has to be made. Effectively, if you're looking at retirement savings, you're looking, 20, 30 years out, and you'd probably still keep the usual 70-30 or 60-40 growth assets to defensive assets. At the moment, we tend to overweight growth assets, but not by very much, because of the risk that there is a W or some other sort of fall.
Mm-hmm. I've got maybe one question now before we open up to the rest, and then we'll see how we go. And the question, I guess, relates to equities. We haven't talked much about equities. There has been various commentaries out there about whether the markets have dropped a lot 2 weeks ago. It's recovered, I think, dropped 30%. It's back up 15%. And the question becomes, is at the bottom? Are we? Is still way to go down, or it's on its back way up? Again, I don't want to go into this whole crystal gazing and predicting markets, but given the way equity markets have performed in the last few weeks, what's your view on exposure to equities from the investor's perspective? I mean, is this time to underweight equities, or is it time to let's average in a bit more? What's your view on that?
Yes, our view is because of the massive monetary and fiscal stimulus being put in, that now is a time to get into equities, but not too much. So you don't bet the bank on it, but you go towards your normal weighting in equities, which should be underweight, should have been underweight, preferably, in the middle of February, in hindsight. But say you normally had a 70% equities, you'd probably want to get back up to 60% in equities or thereabouts today. So still a little bit underweight, but not by too much, because the chances are that there may be another downturn, but it won't be that deep. And so you're better off to stay in and take advantage of the stock picking opportunities if you can still get them.
Right. Thank you, Jonathan. I might just pause at this point in time, and maybe Sophie could help me unmute the other folks, the audience out there. And if anyone has a question now, we'll see how we manage this. There's just a few of us out there. feel free to jump in and ask perhaps Jonathan any question. Any takers? Yes, do I have a question there?
Yes. Thank you very much, Jonathan, for taking us through the update. It's a privilege to have you this afternoon. Thank you very much for taking the team. My question is, I'll start with a comment first, and then probably throw you a question. We have been investing in an objective-based asset allocation for the past 5 to 6 years in a multi-asset fund. So we are quite pleased to hear from you that the multi-asset funds have been quite disciplined in how they restructure quickly their portfolio to actually minimize the risk. That I think for us as investors, that is what we want to see and realize as we go through these challenging times. Given the situation that we are in, I think our funds have been restructured. Do you think we still need to remain there rather than pursuing further and start drawing out of these funds? What is your advice on this?
No, I think you're very, very well positioned, Penny. As well positioned as you could be going into this. You may want to look at tweaking the proportions in the different funds, because a couple of the funds that the multi-asset funds that you're in haven't performed as well as one of the others. But also the diversifiers that you've got are working very well. We talked about equities when Tech was asking about that, and your equity portfolio is doing very well, as is the private equity.
Jonathan, if I could ask, when you say equity is doing well, I guess well in the current context, is that flat? Is that -2 versus -10, 15? Is that well?
No. The market's down, a long way, but they've gone down less than the market, and they're going up faster than the market. So they're still negative today, but they're going up quite well since the 20th of March.
Thank you. Any other questions from the audience? Maybe I could continue on and then we see. Just feel free to jump in. Jonathan, you mentioned cash is king, and we all get that. In the current scenario, should investors be just sitting on cash, or should we be deploying cash? And if so, where?
Yes, so basically, you don't want to be sitting on half your fund as cash, but if you've got 20% in cash, that is very useful, and you would look to deploy some of that over the next few weeks, some into shares and some into private equity, I'd suggest at this point. But again, it depends on the manager's style and what opportunities they see, because there's an awful lot of businesses out there that won't survive this little dysfunction in the global economy if it goes on for more than a few months. So in that sense, you have to be selective, but definitely in our view, we're past the worst in terms of the shock, both of the markets dropping really fast and liquidity freezing up. That's stopped. But also the COVID-19 pandemic isn't under control in some countries yet. It's still terrible in larger countries with higher population densities. But in other parts of the world, things are looking a lot better. And that's why we say we're not encouraging you to take big risks, but we're saying it's better to get in a little bit early and risk getting a loss rather than just sitting on the cash for too long.
Mm-hmm. And on these shares and equities, is it worth thinking about styles? Now, again, before this crisis, there was this debate around growth versus value. And there were lots of questions about when value is coming back. It hasn't been back for 10 years, maybe for a couple of weeks in those 10 years. Is it worth thinking about it in those terms?
So value is still behind growth, ironically, but value must come back into its own during this period if the value managers have actually got their calls right. So we favour value, and we favour being unhedged in your offshore assets because of the extra levels of protection or diversification they offer.
I think there's a question from John Peterson. John, do you want to ask?
Yeah, guys, can I just sort of change the, instead of talking about sort of the basics in investments, Jonathan, what's your view on, obviously China's recovered or recovering, we think. The US is the absolute buddy basket case. We've got elections coming up, hopefully, or maybe not so hopefully, depending on who gets reelected. How do you think down the road this is going to affect things? Obviously, China is going to come back stronger and quicker than the US. How do you see that affecting the markets down the road?
Well, I mean, it's interesting. China has clearly underreported its cases, but because it's a command economy, it is actually managing the infection rate and the death rate better than the US. I think it all depends, John, on who you think is going to win the election. Because, I mean, I'm hopeful that President Trump is finally learning that this thing is serious and is starting to take some decisive action. But Premier Xi Jinping is running rings around him politically and geopolitically. And one of the risks that we see for next year is, in fact, that some geopolitical incident or accident happens just to make things worse again. But clearly, at the moment, China is again leading the world. It's still the manufacturing center of the world. I think as a result of this pandemic, more countries are going to have to look to their own supply chains and more manufacturing in-house or in the country rather than rely on other people in other countries doing it for them. So in that sense, yes, I think it's just part of this ongoing geopolitical shift of power from the US to China, which has been going on for decades now. But this could be a political opportunity for the Chinese to get another step ahead.
Yeah, I would agree. I think the big issue in the States is, of course, that the current leadership is sort of delegating a lot down to the States. You know, I guess similar to Australia, except I think the Australian head of the States are now pretty much unified and obviously doing sort of their own thing, but they're following the lead, where in the States you've got the likes of Florida, who's really a basket case, and as we know, 70% of the population of Florida are old guys like us, so very, very suspect to things happening. Yeah, so it's you know, I would agree that hopefully there'll be some more sensibility in the States, but as I said, I think sure China's got their short-term and long-term plans now, and obviously it might decide to activate some of the long-term plans in the short term.
Yeah, the US could actually strengthen as a result of this if the president and the state governors start being sensible and developing the health system. But that's the real problem, that the health system in the US, as you know, under Obamacare is useless and dysfunctional, and it's costing their people. I mean, today they're probably going to lose 2,000 people to this thing in one day, and that's quite a high casualty rate.
Well, as we know, the privatization of the health system in the States is an amazing situation which can't be carried on one thing, but who knows? I think we're all very lucky to be in the countries we are, where we've got a good strong health system. So.
Agreed.
In fact, John, just to put some numbers on that, I was in a phone call about an hour ago with one of the portfolio managers at one of the Australian super funds. And the observation is that recently, so emerging market equities have done okay recently, and China in particular has been positive. So the commentary out there is that there's been green shoots, emerging markets, China as well. So something to look at. Now, I'd like to probably end this in a couple of minutes' time. I've got a final question for Jonathan, but before that, are there any other questions from the audience? Anyone wants to raise? If not, Jonathan, perhaps final question, and then we can wrap up in the next couple of minutes. Something we haven't touched on, but I think it's important from again, at the asset allocation level, the issue around currency. How important is currency? And again, given the fact that sometimes we see whether this is Aussie dollar or the New Zealand dollar have been currencies that are more correlated to the emerging markets, and in times like that have gone down. Effectively, an unhedged type position would be positive. How do you see currency playing out now and obviously in the future, and how that impacts the way portfolios are structured?
So the issue with the Australian and New Zealand dollars is that they're basically risk on currencies. So when stock markets are going up, our currencies strengthen. When stock markets are going down, they depreciate. And since the bulk of assets are denominated in US dollars, this means that you effectively get a natural hedge. So your share market goes down, but your return in Australian dollars or New Zealand dollars is a bit higher than it otherwise would be. As John said, just in my answer to his comment, the US dollar is now overvalued and is likely to weaken. So that'll strengthen our currencies, but it's not clear at this point how the shift from the US dollar being the reserve currency to a basket of reserve currencies will work, because clearly the euro is not coming up to challenge that position. And I don't think the yuan is quite ready to yet, even though they are part of the special drawing rights now, and they're coming out with a digital currency soon. So in that sense, I think we're still stuck with the US dollar. But the other problem you have with the Australian and New Zealand dollars is that because they're both floating currencies, hedge funds and speculators try and push them down and basically short them. And the New Zealand dollar is being short sold at the moment, and I suspect the Australian dollar is too. So the fact that they're both actually just starting to rise a little bit against the US dollar is significant. So in terms of portfolio construction, with very low interest rates, you can't make any money on the carry. In other words, investing the cash to do the hedging. So our advice would be to leave your foreign assets unhedged, but as a risk mitigator, have quite high domestic assets, so Australian and New Zealand assets in proportion to global assets.
Great. On that note, I might just end. I might just ask, is any other questions out there? If not, we're about 12:45, so apologies if overran for about 10-15 minutes. But I think this has been quite a productive discussion. Obviously, things change, and for all we know, tomorrow is a different day, and markets are different. But hopefully, this gives everyone a sense of the thinking around it, and then hopefully this will make a difference. So I'd like to just thank Jonathan for your time and for your slides and sharing your perspectives, and for the rest of you for taking time to join us. Hopefully, we can do more of this. This is the first of hopefully many, and in using technology that's available to us. So again, once again, thank you very much to Jonathan, and for all of us, have a great day. Thank you.